How to invest like a pro, a beginner's guide to stocks, bonds, and ETFs. Have you ever felt like investing is only for the pros? Like the world of stocks, bonds, and ETFs is just too complex to break into? Well, I've got good news for you. It's not as hard as it seems. In fact, by the end of this video, you'll not only understand how to invest, but you'll know how to do it like a pro. Today, we're breaking down the essentials of investing in simple terms. No complicated jargon, no confusion. Whether you're just starting out or looking to refine your strategy, this guide will walk you through stocks, bonds, and ETFs with real-life examples you can relate to. Ready to take control of your financial future? Let's dive in. Section 1. What are stocks? Alright, let's start with stocks, the investment everyone's heard about. When you buy a stock, you're buying a small piece, known as a share, of a company. It's like owning a tiny fraction of a business, whether that's a tech giant like Apple or a coffee chain like Starbucks. Why do people invest in stocks? Simple. Growth. When a company does well, its stock price goes up, and so does the value of your shares. The more the company grows, the more your investment grows. Example, imagine this. You buy 10 shares of Apple at $150 per share. A few years later, Apple's stock price jumps to $300. Now, those same shares are worth $3,000 instead of $1,500. But here's the thing. Stocks don't just grow all the time. Prices can go up and down based on how the company performs, or even due to broader market trends. The key to investing in stocks like a pro is patience. Over the long term, the stock market has historically gone up, but if you panic and sell during a downturn, you might miss out on the recovery. Section 2. What are bonds? Next up, we have bonds. A more stable, less risky investment than stocks. When you buy a bond, you're essentially lending money to a government or a company. In return, they promise to pay you back with interest over time. Bonds are a safer investment because they provide fixed income, meaning you know exactly how much you'll earn. Example, let's say you buy a $1,000 government bond that pays 3% interest. Every year you'll earn $30 in interest. After the bond matures, say in 10 years, you'll get your $1,000 back, plus all the interest you've earned along the way. Bonds are great for stability. They don't grow as fast as stocks, but they're less likely to lose value. That's why many professional investors use bonds to balance their portfolios. If stocks are risky and volatile, bonds are the steady counterpart. Section 3. What are ETFs? Now, let's talk about one of the most popular investment tools out there, ETFs, which stands for Exchange Traded Funds. An ETF is basically a basket of different investments, stocks, bonds, or other assets, all bundled together. Think of it like this. Instead of buying individual shares of, say, 500 different companies, you can buy one ETF that holds shares in all 500. Example, one of the most famous ETFs is the S&P 500 ETF. When you invest in this, you're investing in the 500 biggest companies in the US, like Apple, Amazon, and Microsoft, all at once. ETFs are great for beginners because they offer diversification, which is a fancy way of saying your eggs aren't all in one basket. If one company in the ETF struggles, the others can help balance things out, lowering your risk. Pro tip: many investors use ETFs because they offer a low-cost, diversified way to grow wealth over time without needing to pick individual stocks. It's a powerful tool that even pros use to build a solid foundation. If you're finding this guide helpful so far, go ahead and like this video and hit subscribe for more content on investing, personal finance, and building wealth. Your support helps us keep bringing you easy-to-understand financial tips. Section 4. Investment Strategies. How to invest like a pro. Now that you understand stocks, bonds, and ETFs, let's talk strategy. Because knowing what to invest in is one thing, but knowing how to invest is where the pros really shine. 1. Diversification. First up is diversification, and it's the golden rule of investing. Diversification means spreading your money across different types of investments so that you're not relying on just one. For example, if you put all your money into one stock and that stock crashes, your entire investment takes a hit. But if you have money in stocks, bonds, and ETFs, you're much safer. Example, imagine you own shares in Apple, a few government bonds, and an S&P 500 ETF. If Apple has a bad quarter, your bonds and ETF can still earn you money, keeping your portfolio more balanced. Think of diversification like building a team. Some players might have a bad day, but others can still help you win the game. 2. Dollar cost averaging. Next up, let's talk about a strategy the pros swear by: dollar cost averaging. With dollar cost averaging, instead of trying to time the market, you invest a fixed amount of money on a regular schedule, say $200 a month, no matter what's happening in the market. Some months, stocks will be more expensive, and other months, they'll be cheaper. But over time, you average out the cost. This strategy takes the emotion out of investing. You don't have to worry about buying at the perfect time because you're consistently investing. Example, let's say you invest $200 a month into an S&P 500 ETF. Over time, whether the market is up or down, you're buying shares. In the long run, this often results in solid returns because you're not trying to guess when the market will hit rock bottom or peak. 3. Long-term mindset. Finally, let's talk about the most important strategy of all, investing for the long term. The biggest mistake new investors make is trying to get rich quick. They buy and sell stocks based on emotions, thinking they can outsmart the market. But here's the truth. Pros play the long game. They know that wealth is built over years, not days. The stock market will go up and down. It's natural. But over the long term, historically, it trends upwards. So don't panic when the market dips, and definitely don't sell in fear. Stay focused on your long-term goals and give your investments time to grow. Example, if you invested $10,000 in the S&P 500 in 1990, it would be worth more than $200,000 today. That's the power of long-term investing. Section 5. Common mistakes to avoid. Let's wrap things up by talking about some common mistakes new investors make and how you can avoid them. 1. Chasing hot stocks. One of the biggest traps is chasing after hot stocks that everyone's talking about. Whether it's the latest tech company or a trendy startup, sure, some might do well, but investing in something just because it's popular is risky. Instead, do your research, stick to your plan, and invest in companies or ETFs you believe in long term. 2. Timing the market. Another mistake? Trying to time the market. No one, no matter how much experience they have, can predict exactly when the market will go up or down. Instead of waiting for the perfect time to invest, start now and use strategies like dollar cost averaging to smooth out the highs and lows. 3. Ignoring fees. Lastly, watch out for fees. High fees can eat into your returns over time. Whether it's for mutual funds or other managed investments, be sure to check how much you're paying in fees. ETFs are a great low-cost option for beginners because they typically have very low fees compared to other investment options. Section 6. Recap and closing thoughts. Alright, let's recap the key points. 1. Stocks. Offer high growth potential, but come with more risk. 2. Bonds. More stable and less risky, bonds provide fixed income and are great for balancing out the ups and downs of stocks. 3-point ETFs. Diversified, low-cost investment options that combine multiple stocks or bonds in one package. They're perfect for beginners who want to spread risk across many investments. And don't forget the 3 key strategies to invest like a pro. Diversification. Spread your money across different types of investments to reduce risk. Dollar cost averaging. Invest consistently no matter what the market is doing to avoid emotional decision making. Long-term mindset. Stay focused on your future and let your investments grow over time. Remember, the biggest mistake you can make is not getting started. The earlier you begin investing, the more time your money has to grow. So don't wait. Take that first step today. If you found this video helpful, be sure to hit the like button and subscribe to the channel for more tips on investing, personal finance, and building wealth. Thanks for watching, and remember, when it comes to investing, it's not about being perfect, it's about being consistent. See you in the next video.